Hello everyone, welcome back to my YouTube channel. So in the previous video, we spoke about IFRS 9 much more in detail from the provisions perspective, and then I compared IFRS 9 with Basel and I showed you the whole pipeline. Okay. In today's video, I am going to completely end the concept of IFRS 9 for all the aspiring credit risk analyst. Okay. Whether you want to do any job, whether you want to just learn for your knowledge, this is a video for you. I am going to tell you how we have to make the mechanism of delinquency, how the mechanism of bad definition works, how the staging in IFRS 9 works, like stage 1, stage 2, stage 3, all of that. So now let me take you forward. And when we move forward, so this is the whole concept which we covered in the previous class, okay, in the previous video. Like what is IFRS 9, how bank make profit, okay, all these things we have already covered. So let's make a small revision. So there are two financial statements in the bank which are always used. One is your profit and loss statement. Second is the balance sheet. So in profit loss, there are income and expenses, there are interest based incomes and then non-interest based incomes. Then in expense, you have sales and processing. And then we took the example of a bank, that how they are making profit. Then in the profit, what is the part of provisions, which is the key component in IFRS 9. Then dividend and stakeholder, how the earning works. When the provision go up, the stakeholders dividend go down. We spoke about it. Then we spoke that this is a growth versus sustainability issue, all of that. Then we spoke about IFRS 9 takes about provision. It all perspective of the IFRS 9 is about provision, which handles the expected credit loss. Then in Basel framework captures unexpected credit loss, focus on the capital adequacy majorly, so that it is a kind of a bank is fully liquidated and there is a car model involved into this. So long term game is all about IFRS 9 because that makes the provision and it makes the business sustainable, so that the stakeholders are getting the benefits long term, not just short term. Then we spoke about balance sheet, that in balance sheet we have assets and then liability. What are the assets? Like loan and properties which bank have. Then liability, which is accumulatively call it as a capital, which is like the combination of savings account, current account, all of that. Now on Basel level, what are the stress testing method we use in banks? All the banks use Python or SAS or SQL, PowerBI in this, okay, calculation. And then there is tier 1 capital, tier 2 capital, tier 3 capital. So this was the precise breakup of the previous video. Now let's start from scratch today, okay. So in any model, when you are building a model, the first thing you check is what is a bad definition. Now what is bad definition? Let me tell you. So when I am making a IFRS 9 model or any Basel model for the benefit of the bank, so there is a riskiness involved, okay. Obviously, the first thing is the risk factor. So to mitigate this risk, we are creating a model which can be a regression model. Okay. Let's say it's a logistic one. So where the output is in the form of yes or no, or we also call it in the form of binary. So your output will be either default, the customer is default, or non-default. Only two output. So in this case, you need to understand what is a bad customer. Obviously, you will ask, okay. So for calculating how many bad customer we have in the bank, we do roll rate analysis. So this roll rate analysis tells about the bad definition, where we check a consistency graph of the customer. Then there is a shift, obviously how many customers are shifting. But let's not go there much in detail, because in many of the company, majority of the company, as per my experience, I have seen the bad definition is already given in the documents which are handed over to you when you are going to do code. So what is a bad definition? A customer who is more than 90 plus day past due. We call it 90 plus DPD. That means the customer is not paying the EMI from last 3 months. That is known as a bad customer. That is simply the definition of a bad customer. Some small bank usually do this roll rate analysis, but major banks, all the big banks, Citi, Wells Fargo, Standard Chartered, HSBC, all of them already have a bad definition. Okay, this tells you that what is a bad customer. Okay, this basically tells you what is a bad customer. So this answer this particular question. Now, when you talk about the lending, so we are obviously giving loans. Loan is one example. Second example is credit card. What are they? They are lendings. We are the lender as a bank, and the people who are taking, they are the borrower. Okay. Now in this lending process, so there are two type of lending if I categorize it. One is your retail products. Second are your commercial products. So retail are usually those products which are like savings account, current account, where an individual person is involved in this. So in retail lending, the customer base is usually large. Customer base is large. Because how many people would be using the credit card? Thousand, lakhs of people. So customer base is large, but the exposure to risk is less, average level. Okay, I'll tell you how. Exposure to risk is low, because every customer, if you see, so on an individual level, a customer, what will be the limit of the credit card? 1 lakh, 2 lakh, 5 lakh, 10 lakh, 20 lakh, that's it. So for a bank which works in billion, this 5 lakh, 3 lakh is a very small amount. Customer base is very huge. But if you talk about one customer out of that, or two customer, or even like 5% customer out of it, so the exposure to credit risk is low compared to the commercial one. In the commercial one, the thing is that your customer base is very low. What is commercial? Commercial means companies, small industries. For example, any company, let's say we take the example of Infosys. So Infosys want to build a campus in Pune. So Infosys go for a loan. So that is a commercial loan. Now that single loan can be more than the whole retail portfolio. So the customer base is low. Counting of the customer, let's say only Infosys, TCS, 2 customer the bank have. And in retail, the whole Pune employee of the TCS, but TCS itself can take the loan which is greater than the all the employees, obviously, right? So here the exposure to the risk is significantly high. So this concept is clear now. Okay, I'll connect the dots. Okay, this concept is clear. Let's move a bit forward. Okay, now there is a concept of delinquency. We call it delinquency. Now, what is the delinquency? And there is a difference between delinquency and a bad customer. So you should know that. See, delinquency means if a customer is not able to pay the money for a particular month, that is a delinquent customer. So when we give the loan, so there is a month when the loan was originated, given to the customer. Now this customer have the money, so obviously they will start paying the EMI from the first month. So obviously on the month 0, the customer cannot be delinquent. Let's say on month 1, he paid the EMI. EMI done. Month 2, also customer paid the EMI. Now on month 3, due to any reason, let's say business is not working well or the customer lost the job, so he could not pay the EMI. So in this month, the customer became delinquent. Now again next month, customer paid the EMI. He got the job. So now we will not move this customer to the bad definition. This is a delinquent customer. Again, on the month 5, he did not pay the EMI. He lost the job. Month 6 also, he could not do it. Now in month 5, he was delinquent, which we call DPD, day past due, only 30 days, because he did not pay the EMI from 30 days. By the end of M6, month 6, he is DPD 60, because he did not pay the EMI for 60 days. Now month 7 also is a deciding month. He did not pay the EMI. Now he is DPD 90. And the moment he enters into month 8, it's DPD 90 plus. So this DPD 90 plus, which you can see here, okay, this DPD 90 is known as your bad definition. So this customer is not a delinquent customer, it's a default. So there are so many databases buckets. So let's say I have a database in my account. Let's say I'm using Oracle. So in my database, I will create so many different tables. There will be tables DPD 30, table DPD 60, then there will be table DPD 90. And all of them have delinquent. This one will have the default customer. Okay. Now this is the concept you should get. Now let's move forward. Okay. Now let's talk about a certain portfolio. Let's take the example of kind of a product which bank have, so that you can connect the dots. So I'll take the example. The example can be anything. Let's take portfolio, let's say personal loan. Let's talk about personal loan. Okay. So in personal loan, whenever you are giving the loan, there are two things. One is your term. What is the duration of the loan? Second is what? In any loan, term and what? Amount, which is your principal, which you have taken as a loan. This is a insecure product. Now what is secure, what is insecure products? Okay, so when you talk about insecure products, so they are the product which do not have any collateral. And when you talk about secure products, so the product which have a collateral attached to that, let's say house loan. So if you are not able to pay the loan, the bank will sell your house, so that is a secure product. Now in this, if you see, let's come back to the personal loan. When you combine the term of the loan and you combine the overall amount, that come as a principal, three component, principal plus interest plus your term. Now this is very simple. Okay guys, I am not going to go deep and dive and what is principal. Principal is the main amount, right? All of you should know that by now. Okay. Now when I am going to apply, let's say IFRS 9 into this. So what is the asset class here? The personal loan. Personal loan is known as an asset class. So if I am going to apply my funda of IFRS 9 here, what I will do? IFRS 9 will ask me to calculate the expected credit loss given by this personal loan. Let's say if this customer, my customer name is Rajat. If Rajat is not able to pay the amount at any point of time, let's say he took the term of the loan was 2 years, which is equal to 24 months. So if Rajat could not pay the loan at any point of time, so bank need to calculate the expected credit loss here. Now IFRS 9 tells that you should calculate for two stages primarily. One is your expected credit loss for 12 months, then expected credit loss for lifetime. That how much loss Rajat can give us to the bank, okay, as a bank. Now, if I drill it down more, so when I spoke about the stages in IFRS 9, there are 3 stages. I spoke about this too on the PD level. See, first we calculate 12 month, then calculation happens lifetime. So from the calculation perspective, it's 2. But the real answer of how many stages the IFRS 9 have is 3. Okay. And there is a mechanism of staging. So you have stage 1, then you have stage 2, then you have stage 3. So in this particular IFRS 9 model, you have 3 stages calculation of ECL overall. Now what is ECL? ECL is expected credit loss. So for ECL, there is a formula. ECL equal to probability of default PD multiplied by loss given default LGD multiplied by exposure at default. Probability of default, what are the chances that a person is going to default? LGD means loss given by the default at a particular point of time. What is the loss given by the default? That is LGD. Exposure at default at any point in time. What is the exposure at default is known as a EAD. Now, when you talk about the stages, so obviously the first question will come, how we divide the stages. So for now, just understand one thing. In stage 1, what are the accounts? Stage 2, what are the accounts? And in stage 3, what are the accounts? So which account we are keeping? So let's say you have 1,000 of accounts. So all the non-delinquent customer are part of stage 1. When there is a significant delinquent customer, okay, significant decrease customer are part of stage 2. Significant delinquent. And all the customer who are giving all the impairment, the bad customer, they are part of stage 3. Impairment, or we can also say bad definition customers. Now you know the concept why I explained, because I told you 90 plus DPD are part of this stage 3. Now if you say, so there are buckets, I explained it to you in database, you have buckets, okay. Now when we think about the personal loan here, so I divide using IFRS 9 concept, stage 1, stage 2, stage 3. Then obviously you will ask me that, Rajat, what is the basis of this stage? How we are doing the staging? So there is a base of stage that all the non-delinquent customer are stage 1, which have not done any delinquency. There are significant delinquents, sometimes they became delinquent, but they could not move to the bad definition. Okay. Then stage 3 is all impairment. Now, when I spoke about personal loan as an example, so you say we talk about impairment. Because IFRS 9 is ultimately what? It's an impairment model. So in this impairment, what are the main thing we check? The bad accounts, which is coming from bad definition of the customer. So bad accounts, and what is that? 90 plus DPD. So all of them are bad here. Now, how we predict? We predict on the basis of the behavior. Predict on the basis of behavior of the customer. This is pretty much clear. Then we spoke about stage 1, stage 2, stage 3. So this pipeline is clear. Now non-delinquent are part of this, then significant delinquent part of this, and impairment are part of this. Okay, so this is how the staging works. So you should be knowing this whole pipeline by now. Now this is the overall breakdown of IFRS 9. That's what the difference between Basel and IFRS 9 also, which I told you yesterday. Now if you see here, we are just worried about the stage wise delinquent people, and we are focused on the provisions, which is making arrangement from your profit and loss. What is the net profit? So from net profit, you need to make the provisions to secure all these stages. Okay, especially stage 2, stage 3, and more importantly stage 3. The impairment if comes from stage 3, so you should be having enough money in your pocket from the profit and loss in terms of provision, so that you can eliminate the shutdown of the bank, so bank can function. Okay, now this is very important. Now just to summarize all this at the final level, because usually we have this doubt, IFRS 9 and Basel. I already spoke about it, but let me give you a quick summary. IFRS 9 spoke about provisions. What is provision? Provisions are part of profit and loss, which is as a you have a net profit. So from net profit, you are securing some money in terms of provision. While your Basel model works on the capital, it talks about capital adequacy. And it asks you to keep the capital on the tier. Tier 1, Tier 2, Tier 3. Tier 1 is known as equity capital. And what is Tier 2 capital? When you utilize 100% of the Tier 1 capital, that is equal to Tier 2 capital. Tier 3 capital is the subsequent amount of a capital, which is very small. Okay. Now here, impairment comes with respect to your provision. Obviously, this is pretty much understand. Okay. These are very sensitive for macroeconomic conditions, because if there is a war in a country, how they will make the profit? No profit, right? So that's why it's very much dependent on the macroeconomic factors, which are in terms of variable in your data. Pretty much clear? Now we calculate point in time probability of default here, because at any point of time the economy can go down. So obviously point in time PD, which we call PIT PD. Now in Basel, capital adequacy ratio is there. Obviously then we spoke about this tier 1, 2, 3. Now why we are doing all this? To absorb unexpected credit loss. So that was a summary. Okay. On that note, we completed the IFRS 9 concept from the credit risk portfolio. Now all these things we usually implement using SAS, R or Python. Then the dashboarding part is usually done in PowerBI. If you like this video, on that note, please subscribe to my channel. Please hit the like button, and for such amazing content, please check out my other playlist, because I teach Python, SQL, Power BI, and lot about my 13 years of experience into IT sector. On that note, thank you everybody. All the best.